All right, everybody. Today we'll be walking through why long-term care policies, insurance policies you have that might pay for long-term care, might be the worst thing to use to actually pay for your long-term care in the future. We're going to cover why and what are some alternative options that you can use here that might actually be more tax efficient for you and your portfolio going forward. So first, let's kind of recap, like what are these long-term care policies I'm talking about? A couple ones are out there. A lot of these typically will have a death benefit, okay? And they also can cover long-term care. Now, if you're just paying for a monthly long-term care policy, now that is not what I'm talking about. Those aren't as commonly used as premiums can go up in the future anymore. You might have one as you're paying into though, maybe for a very cheap rate if you bought it when you were younger. If you do, that's great. This probably won't affect you. What I'm talking more about here are policies that someone might do either through like an IUL policy, a whole life policy, or there's a long-term care rider on here potentially, all right? A lot of people will buy these nowadays where they'll buy this policy, there'll be a large death benefit on it, but then there also will be a cash value and a long-term care benefit that they can use if they ever end up in a nursing home down the line. Now, in a lot of cases, sometimes that is not the best thing to use in this situation here, right? And a couple of reasons why. So when you use this benefit, okay, you're taking away typically from a death benefit. So I'll give an example here. Someone might have a policy that has a death benefit of $800,000. But with this policy, they're able to use, let's call it $500,000 of long-term care benefit, or sometimes the whole death benefit they'll allow you to use for long-term care. So if you end up in a nursing home and you spend $120,000 a year and you're in there for about 5 years, you're going to use $600,000 of this death benefit amount. If that were to happen, then once you pass away, there's just $200,000 that'll go to beneficiaries. Now, you use it for the right thing, but what I'm saying is what's happening right here might not be the most tax efficient thing to happen. And we're going to share with you why. So from a medical expense standpoint, okay, if you're paying $120,000 for a long-term care facility, that can qualify for a medical deduction on your tax return. Now, how does that work? Well, for medical deductions to take place, you can deduct anything over 7.5% of your AGI. And that's your adjusted gross income. So what'll happen a lot of times with these benefits, except previously, they are not taxable when they come out of here. It's actually a tax-free benefit in a lot of cases. And because of that, we don't have any adjusted income typically, just your Social Security, right, if you're still getting that. So what ends up happening here, we get really no deduction for medical expenses because all our income now is tax-free. But what you could do instead, right, imagine you're somebody that might have an IRA account and you have this policy, which we tend to see a lot. A lot of people come into our office, where now we have maybe $1 million in our IRA, and we have this $800,000 policy that we talked about earlier. Now here's the question. We're going to a long-term care facility. Most of this money is probably going to end up going to beneficiaries down the line. All right. Now, also on your end, you're probably going to pay the same taxes either way, but your beneficiaries can save a lot of taxes if we make the right move in this situation. So what we could do, instead of using this death benefit up, because if we pass away, this death benefit, keep in mind, is completely tax-free for your beneficiaries. So tax-free $800,000 if we leave it there and don't use it. The IRA gets taxed. So we have $1 million in our IRA account and that gets inherited by somebody. They have 10 years to pay taxes on this IRA. And they're going to take over $100,000 a year, pay ordinary income tax on that, on top of all the other income that they have coming in at that point in time. So what we could do for this long-term care, right, facility that we're talking about here, if it's $120,000 a year, we can take it out of the IRA. and we actually don't use the insurance policy that you have. So we take it out of this IRA, we take $120,000 out of here. Now, why do we do that? Well, now we have $120K of adjusted gross income coming in. And all of that, except for 7.5%, so in this case, around like $8,500, right, is going to be tax-free. So the IRA that normally will get taxed very heavily, but because of these medical deductions that you have, this distribution we're taking out will pay very little taxes on it. In fact, the only tax we'll pay is on $8,000 of income, which will put you in the 10% tax bracket. So we'll pay $800 of taxes total. Now, if we do this, and you're in the nursing home for, let's say, 4 to 5 years, we'll call it 5 years to make it kind of even there, we would take $600,000 out, and we'll pay around $3,000 in taxes along the way there. So not a lot of money. All right. Now, conversely, if we were to take that $600,000 and that got inherited by your kids instead, and they're making money today and they're in the 24% tax bracket, they're going to pay a lot more taxes on that money. And a tax increase, 6 times 24, do some quick math here, right? We're looking at now, in terms of what we'd have at the end here, sorry, quick math on my end, that's $144,000 that we're now going to have to pay in taxes. Instead, we paid $3,000. We're looking at a $141,000 tax saving when we look at this. And I talk about what money we took from first for our long-term care benefit. And now what happens, you're probably wondering, well, what about this $800,000 benefit we talked about? Well, we don't use it for long-term care. That just goes to your kids. And it goes tax-free, the whole entire $800,000. And now they'll get that tax-free plus, not this $600,000, but they'll get $400,000 remaining out of the IRA. Now we're assuming like no returns here. That might be a little bit higher if we get some returns over those next 5 years. But it's $400,000 now. They'll take this out over 10 years. But now it's only $40K compared to $100K they might have had it taken out. So now we're helping your beneficiaries. They're going to pay less taxes on your estate. You're going to pay less taxes overall on your end too, because you're not paying that much more in taxes. And overall, we're going to be saving around $141,000 in taxes by using the IRA instead of your long-term care benefit in that IUL policy. Okay, so hopefully this is helpful, right? If you're thinking of getting an IUL policy or getting something for long-term care, keep this in mind, where if you have a larger IRA today, you might want to use that for long-term care down the road as opposed to using your long-term care policy that you might have as well. Hope you enjoyed the video. Follow our content for more information like this. Subscribe to our channel below, and we'll talk to you soon.